There we go.
Good morning. My name is Don Vivrette. Pete Kote is with me here. We're going to go through today on It's Your Money. This is week 3, equities and fixed income investing. We're out of sequence a little bit just because of scheduling issues that we have. That's not a problem. We're going to cover everything as we go along. So this is our week 3 of the session. As we have shown you before, there is a workbook if you want it on the website, and we may show you that later on in terms of how to get in there. But if you just click on that link that's on your email, you will come to this spot. The workbook was done basically to be sort of a connection between all the 6 weeks. And that's what all is in here. It is for your purposes. It's for your interest. You can watch the Zoom videos again. You can, any of the sessions, you're very welcome to go through. Where we are today is in week 3. So we're doing equities and fixed income investing. And that's what we're going to do. Next week, we will go to investment world, then medical planning, and then finish off in week 6 with financial planning 2. So I'm going to stop sharing. And I'm going to pass this to Pete, who's going to introduce John and Kurt. And I will go dark and be in the background. And I will ask questions as they go along. So again, please feel free to ask questions on Q&A. And Kurt and John, come on down.
Hello, John. Hello, Kurt.
Hi, Pete.
Good morning. This is for introduction purposes, financial and estate literacy, and we're a not-for-profit, and we're all about trying to educate you regards to your money, to your estate, and possible charitable gifts. We're a little bit out of sequence as far as what we normally do on the equities and the fixed income. So today's session is all going to be about investing your assets, and we'll get into some of the other points a little later. To introduce John and Kurt, I would like to bring up, Don, their Ask First form, or is that feasible?
It's in their presentation.
It's in their presentation. Guys, you want to go ahead and bring that up real quickly?
Right.
And there we go. This is the Ask First form that there's a blank one on our website, and we ask all of our presenters to complete one. And I'm not going to go into it as much in detail as we did the previous time, but I do want to emphasize some of the more important things. One is, John, you're our first CFA. What does that mean?
A chartered financial analyst designation is very specific to investment management and research, doing fundamental analysis around stocks and bonds. So you learn a lot of accounting and financial analytical tools. The 3-year, well, when I did it, it required passing 3 exams over a 3-year period.
Yeah, there's probably around 125 different designations in the financial services industry, and most of them you can receive those designations by basically paying for them. Is the CFA designation that way, John?
No, it's pretty intense. I mean, it requires thousands of hours of study. You find it on Wall Street and among institutional quality investment managers typically.
Yeah. How many years experience do you have? And talk a little bit about Knightsbridge as a firm.
I helped found Knightsbridge Wealth Management 25 years ago now. And so I have a little bit more than 25 years experience investing in the stock and bond market. And we remain today an independent firm. Kurt and I are 2 of the 3 partners. And we work with private clients directly with them, overseeing their investment portfolio, helping them with their financial planning needs, that sort of thing.
Okay. And you're a fee-only fiduciary financial planning firm. You don't sell any kind of insurance, mutual funds, et cetera. Is that correct?
Correct. We're fee-only. We're a fiduciary. We charge, as you see on the bottom half of the page, an asset-based fee, which is a percentage of the assets under management, which helps align our client interests and ourselves. We're both we're incentive to have portfolios grow. And because they should grow over time, we like to reward loyalty. Our fee schedule actually declines annually. And
so if I bring you $1 million, John, and to invest, how much would you charge?
The first year fee would be 1.1%. And then each subsequent year, the fee declines 5 basis points, 0.5%. So the second year would be 1.05, the third year 1%, declining each year until down to a perpetual 0.75%.
Okay. And does that you've got the chart up on the screen. Thanks. Does that include financial planning, telephone calls, meetings, etc., or are things separately charged?
That includes all of our work, from financial planning to the investment management, typically couple meetings each year, and ongoing open-ended dialogue and discussion, and working closely with the clients, and that's Kurt and myself interacting with our clients.
Okay. Approximately how much do you have under assets under management?
Changes day to day these days, but a little more than 500 million.
Okay, a little more five. And how many staff people do you have, or how big is your firm?
Kind of a boutique firm with one office here in Newport Beach, 10 of us working together.
Okay. What distinguishes Knightbridge from maybe some other fee-only fiduciary financial planning firms?
The declining fee schedule, I think, is fairly unique. The way we build portfolios is different in that we're independent, which enables us to invest the way we want to invest, as opposed to a parent financial institution designing our portfolios for us. And because of that, we want to take advantage of each client's tax situation and where they're at in their life and their goals and so forth for things like asset allocation. But a big difference I've found is our strong desire to manage a tax deferred account, an IRA account, differently than a taxable account. Okay. And invest that taxable account extremely tax efficiently, working within each client's individual tax bracket.
If you had to classify your firm as an active manager or a passive, I know you do both. Which do you lean towards?
Well, we have a pretty good long-term track record on our active portfolio stocks, better than the stock market. So typically we're including active management, particularly in an IRA where we can be opportunistic without worrying about taxes. On a taxable account, we're likely to emphasize exchange traded funds, ETF, because they're extremely low cost and extremely tax sensitive. So they work very well for diversification in taxable portfolios. As you said, we tend to do a little of both. Okay,
Kurt, give us a little bit of your background, and you're a partner at Knightbridge, and give us a little bit about what you bring to the firm and why you're there.
Yeah, no, John may be asking that question every day. No, yeah, my background is been more in the fixed income space, where John has been building portfolios, stock picking and so forth since the 90s. I started my career at PIMCO here in Newport Beach, and then was with another boutique fixed income manager who was actually subsequently acquired by PIMCO. And so my background tends to be more in fixed income, and then as well as working with clients on a range of issues, whether it be financial planning, tax planning, but helping them to build portfolios that align with their goals and help them build their wealth over time. So I started my first 8 years or so of my career was on the institutional side, where you're working on a large team at a large firm managing pension plans, endowment, foundation accounts, things like that. And then in 2012 I moved to work with families and individuals, private clients. So I guess that's 11 years now. Wow.
Yeah. you got a little gray hair now.
Coming in.
The relevant licenses, Series 65 is not really a license. It's more of a registration. because Series 65 doesn't allow you buy and sell products. So we usually consider that a registration, not a license. So, but we're going to talk about that when we get to the investment world, about licenses and all that kind of stuff with FINRA. We're not going to go into that today. You're paid, the firm is a fee-only firm. And so the client is charged exactly the same, whether they see you, Kurt, or they see John. Is that correct?
Correct. And regardless of what they're invested in or the level, of financial planning that is involved, it's the same fee. And I would just say on the Series 65, it sounds like we'll get to that later, but that's what only holding a Series 65 is what allows you to be a fee-only fiduciary, because it does not allow you to take commissions for selling anything like insurance or annuities. Those are different.
And then do you guys offer a free introductory meeting, and so that a client can possibly get to know you a little bit better before they make some kind of a contract with you?
Yeah, we do. Absolutely. I mean, all of our many times it's several free meetings before a client ultimately decides to work with us or not. We also at no cost offer portfolio assessments, where clients will give us just an account statement, and we'll go through security by security, whether they be individual stocks or mutual funds or exchange traded funds, and let them know what we hold, what they hold, what their all in total costs are, tax efficiency or inefficiencies, and what we like about the portfolio, what we would maybe recommend changing. And sometimes people take that and choose to go do it on their own, or other times they say, well, maybe you guys can help us. So we're always happy to provide that service as well.
Okay. Yeah. And there's no cost, no obligation for that as well. Yeah, you guys are really crusaders for the fee-only fiduciary aspect of the industry, and people need to pass that good word around. John, Kurt, take it away. Let's get into the program, and I encourage questions and from the audience, although we're not in person there. It's dialogue, at least somewhat minimum, is encouraged.
Sure. Okay. Well, just a bit of our background. We already touched on this. I think next year we're gonna need to update this, and these numbers are going to be 30 and 20 years. Time is by. Yeah, John's going to talk a bit more about equities here, and I'll follow that up talking about fixed income. Want to take a look at the agenda we have here. We're going to start talking about just the basics of the stock market, how it works, and then we'll talk about how you can prosper in the stock market, how we'd recommend you build your portfolios, and we'll talk about the current environment here, what's going on in 2023 that may be unique to investing in stocks today. And then I will speak a bit about fixed income basics, just making sure we all understand the appropriate terminology, because there's a lot of jargon that comes with fixed income investing that it can be confusing. And we'll talk about how you can optimize your bond portfolio, and then of course talk about the current fixed income landscape, which is quite different than it was 18 months ago with so we'll get into all of that. Yeah.
Hey, Kurt, John, I noticed that you have 60 different pages in your outline today. So I just want to, sometimes people feel that we don't give you enough time to cover it, but I just want you to know we've got a good hour and 15 minutes, and those slides that you don't feel are absolutely pertinent, you can skip over, and just so we can get through the program today.
Okay. Well, we've already covered the first 7, and the last one's disclosure. So
good. Okay.
I'll let John take it away.
Well, I can fairly quickly run through some of these slides, including this first one, which is just the basics on what is a stock. you hear the term equity, it's synonymous with stock. It's a fancy word for stock. The most important thing I want you to take away today is a really simple but critical concept. When you own a stock, you literally own a share of a piece of a business, not just a piece of paper. And you need to think about buying and selling stocks that way. You know, would you be comfortable owning all of this business is a good starting point question. And there's two types of stocks. There's common stocks and there's also preferred stocks. And we here at Knightsbridge incorporate preferred stocks in portfolios because they're really tax advantaged. They pay dividends. The ones we own, the dividend rates are above 6%, and they're taxed at your capital gains rate, which typically is lower than interest, which is taxed at your ordinary income rate. Preferred stocks are also nice because they're senior to common stocks, and the ones we own are issued by major financial institutions, the largest banks and insurance companies, so we feel comfortable with the credit quality. You don't want to really speculate whether it's stocks that are common or preferred. A good example is First Republic Bank's preferred stock went to zero value. Okay, so that's a regional bank that we would, not be as comfortable with.
Would this be the time to buy the preferred stock?
These regional banks are down a lot today, and I'm sure deposits are flowing out. We're being very cautious with the confidence issue in the banking system. One piece of advice to listeners is, if you do have money sitting in a bank and you're concerned, if you have a brokerage account, move that cash to a brokerage account where the brokerage firm won't be lending out that money, so it's more secure. And on top of that, there's SIPC insurance, which could cover the full account value. And it actually should improve your income because money market funds are paying, 4.5% to 5.5%, whether it's taxable or tax-free equivalent. So if you want to follow up with us, we're opening courtesy cash accounts for people to accomplish just that, so they're comfortable. There's different ways to invest in the stock market. You can buy individual stocks. You can buy mutual funds or exchange traded funds. You can do that all through a brokerage firm on your own or with a broker, or you can use someone like us as an investment advisor. The main thing I'd say about this is be leery of mutual funds. The vast majority have underperformed over, most periods because they're very tax inefficient and overly diversified in most cases. So I'd say exchange traded funds, which didn't exist when I started my career, are a really good tool to contain taxes and expenses. So just quickly on what is the style box, this is the last of the basic slides. You can divide the stock market into size of company and style of company. And so Apple is a large growth company. At the opposite, there's some very small, more value-oriented companies. And if you own a growth stock, you're looking for a lot of earnings growth. If you own a value stock, you're looking for valuation improvement because it starts out at a low valuation. We'll talk a little bit more about that. So why should you consider the stock market? This is a great slide because it highlights a lot of tough times. And the trend line there in light gray is obviously upward, and a huge amount of appreciation in the stock market in the long term. The gray bars are recessions. They've become less and less frequent. But the point being that the stock market's managed to work through wars, inflationary periods, shocks to the economy and financial system and things like that. And it's to me, the best long-term investment available is the stock market. It's averaged about 10% per year. Why is that? Well, there's a reason stocks rise over time, and it's earnings. You own a stock, you own a piece of the company's earnings, and earnings tend to increase over time, which is these blue lines here. And the long-term earnings growth trend has been about 6.5%. Get dividends on top of that, and you're up to that 10% type return.
What did you mean by, go back to the other slide. What does that mean? No, not that one. The figure 32, we are skeptical the 85-year trend in earnings has changed. What do you mean by that? I don't understand it.
There's a lot of concern out there that there will be a recession in 2023 in the economy, but also in earnings, and that we'll have a decline in earnings. And this statement is that maybe, but we don't think the trend in earnings has changed. It's been an upward trend for 85 years, and we think earnings will be higher 5 and 10 years from now.
Okay.
In terms of how you should approach investing, you've probably heard the term technical analysis. So our first rule of the day is technical analysis doesn't work. I don't care what the pattern, how you want to try to time the market, don't do it. It's not that easy. You have to put in the work. You have to do the fundamental analysis.
So this is technical. Do very many people buy into this kind of investment philosophy?
I used to get it in the 90s when the market was hot. You know, when times are good and the market's rising, you think you're a genius because everything's rising and any of these technical tools might feel like they work. But I think most people have become more educated and aware that fundamentals matter and technical analysis doesn't work.
Okay, dude, I guess one of the things I'm trying to get at is that they're in the financial services industry. There's a lot of people make money giving advice or going off on a tangent. In other words, investing on the market on technicals. It is an entire industry. I mean, with software associations, newsletters. I mean, this is not just a small little segment. I mean, a lot of people make a lot of money giving this kind of advice.
The newsletters and what you hear on commercials, there have been lots of studies and the results are not good overall. You get a particular newsletter or strategy that will pop up at a time it's done well, but that's backward looking and self-selecting. They're only coming to you with a commercial and an offer, when they just maybe accidentally have done well for that particular time. And I'd stay away from.
Yeah. I wanted to, almost highly emphasize the word fundamentals. You can't ignore the fundamentals.
That's right.
Okay, let's go to the next slide.
Yeah, so just one more view on how good the stock market's been over the long term and why you want to be a long-term investor in the stock market. Whenever we get calls and concern around the issues of the day, I tend to remind clients of this sort of chart that yes, times may be scary and maybe the stock market will drop. You see to the right, the red square, we had a 25% decline last year through September 30th in the stock market. But those bear markets, those red periods, tend to be much more shallow than the up bull markets in blue and quickly recovered and short enough in duration as a bear market that you hopefully have a time horizon that allows you to live through that and get into recovery mode. And just know that most of the time we'll be in a bull market. The average length is 6 years long, whereas a bear market tends to last about a year. And bull markets have delivered an average return of over 200%. Bear markets a 37% loss.
The importance of this chart too is to look at reality, whereas psychologically we tend to remember our losses much more so than we do our gains.
Right.
And, so it's important to try to keep a rational eye on our investments.
And the negative news sells, and there's always concerning things going on in the world. But that upward drive of corporate earnings is more impactful to stock values. And a lot of things we worry about turn out not to matter so much.
Let me interject a question that just came in. So on the previous slide, here's the technicals and here are all these different things. Is artificial intelligence going to change the ability to predict global information?
That's a really good question. Artificial intelligence is a really big deal. It will make the market even more efficient because information will be even more ubiquitous and accessible. And it'll be possible. I mean, maybe I'll be put out of business because you can come up with a full report on a company and a stock. But it's another tool in doing that fundamental analysis to learn the history of the company and about the business side of it. So I don't consider that technical analysis. I consider that a research tool that's very useful.
And GPT, incidentally, will not predict. It won't tell you where the market's going to be tomorrow.
I haven't tried that. Maybe I should.
I tried it, and the answer is no, I won't tell you.
Okay. So how should you invest in the stock market? You want to invest based on company fundamentals, and the key is to invest below intrinsic value. And what does that mean? Well, for buying a stock for less than it's worth. And so really that's predicting all the cash flows in the future for the company and discounting them back to what that means for the value of the stock today. And so if a company is going to grow a huge amount, you might pay more for that growth. Whereas if the company's shrinking, you wouldn't want to pay very much, obviously. So we look at companies and their trends in their revenue and earnings and cash flow and how they're growing, and then how much we're paying for that. So the valuation and some of the primary measures here: price to earnings, stock price relative to the net income, either the last year or the next year, or 5 or 10 year average earnings; price to book, which is something we don't use as much as we did 25 years ago because the economy in the United States has moved, is much more technologically oriented, less about hard asset value, which price to book is more about the asset value, net asset value. Price to sales and price to cash flow. And a way to think about this is you can love a company, but that doesn't mean it's a good investment. You have to know what you're paying for the stock of that company. And a good example is Tesla. Tesla, I love their cars, but you buy shares of Tesla, you're paying 54 times earnings, at least you were a while back. Whereas you can buy Ford as a stock at 6 times earnings. So is Tesla 9 times better than Ford? I'm not going to answer that question, but that is the question. How much are you paying relative to the earnings today and the earnings in 10 years? And it's a lot of work. So rule number 2, it's tough. And so if you're not prepared to put in the work, or you don't have an advisor you feel confident can do the work effectively, don't try to beat the market. Buy an exchange traded fund, own the S&P 500. That'll get you 90% of the way there anyway.
Yeah. So if you're not willing to put in the work, but you don't want to have an advisor, what do you suggest people do? Go to someplace like a Vanguard or a T. Rowe Price or a Schwab?
Yeah, I think Vanguard's good. There's some educational tools. The costs are low. Do a little bit of work to learn the different types of exchange traded funds and the possibilities on diversifying. You don't need to own 50 different funds. You can probably have a nice portfolio in the stock market that only requires a handful of ETFs. Yeah. But you want to diversify, and we'll get to this in a minute.
Okay.
You want to own what's in that style box. You want to own not just U.S. stocks, but you want a global portfolio, particularly right now. And this slide shows why you need diversification across sectors. So these are all the different sectors of the stock market through time, and things change. Early in the Industrial Revolution, it was a transportation-oriented stock market. And then as we discovered oil, energy and green became really big, and now it's 3% of the stock market. It's shrunk. Technology, information technology has become 30% of the stock market. So you kind of have to keep an eye on what the stock market looks like and make sure your portfolio hasn't become obsolete.
I love this chart.
Yeah, so this is why you diversify into different kinds of stocks. Year by year, you see no pattern in colors of what was at the top versus what was at the bottom. So 2023 in blue to the right, cyclical stocks are up the most. 2022, they were down the most. And so we diversify our portfolios, owning different sectors, owning different sized companies. And I think that's prudent to help smooth out your return, as opposed to having your portfolio all be momentum stocks that are up 50% and then down 50%. You want to have some diversification.
Could you go back for a second? Take a look at what 2022 did. You have on the top defense. What does that mean? Is that the defense sector?
No, that's defensive stock. So less economically sensitive companies. So 2022 is a down year for the stock market. The year finished, the S&P 500 index down over 18%. In an adverse market environment, you would expect leadership in things that are defensive, high dividend paying, minimal volatility, and then value stocks started to do a bit better as interest rates are rising. So, you know, if you look at what worked well in a given year, I can tell you what the market environment was like.
So it looked like in 2022, everything was down.
Pretty much. It was a really rough year, and you can see at the low end of 2022, anything economically sensitive like cyclical stocks was down more. And with inflation and interest rates rising, it was hard on most areas of the stock market.
So did you have to kind of counsel your clients to basically stay the course, don't panic? What are the emotions? When your life savings go down?
We try to be down less, which we generally were, and then and give clients some encouragement that, you know, they're probably mostly through the decline by the time they're aware of it and worried about it. And we show them the next slide. And I, you know, if we do a good job, we've educated clients to understand that there's going to be periodic declines, and those are the red dots per year. That's within the year what was the worst loss for the stock market. And so last year it was 25%. And I want our clients to understand that their portfolio, their stocks will be off 5, 10, 15% at some point most years. But if you're not selling and you let the recovery occur, you earn for the year the gray bars. And the average calendar year return in the S&P 500 since 1980 was 14%. And returns were positive 32 out of 43. So the odds of the full year being positive are very high. So you just kind of have to ride out the volatility in the stock market. For the most
So if I'm going to follow up on that logic, so you want to make sure that you have sufficient cash flow for those periods of times when the market is down.
Right. And this gets to asset allocation. And I'm going to say something heretical here. I know typically you'll be told that you should have an asset allocation based on your age. I don't really agree with that. I think you need to know your cash flow needs for the next few years and not have that in the stock market, because you need a portion of your net worth, your investable assets, invested safely, whether it's cash or conservative bonds, that you can draw from for your cash flow needs for that few years the stock market's down and coming back. Because the number one thing is not to sell at the low point. And so you have to know your cash flow needs. That's why we do financial planning, talk to clients, and arrange that appropriate portion of the portfolio not in the stock market to avoid selling, you know, in the spring of 2020 in the middle of COVID with the stock market down 35%. Because if we didn't sell, we ended up making 20% that full year just by hanging in there.
Yeah. So the client really has to come in and talk to you about their net worth, their income, their their spending, so that you can determine that cash flow need.
That's right. There's a couple of conversations about exactly that before we're ready to recommend an asset allocation.
Yeah. You can't just go, hey, this is a hot stock. This is what I'm going to sell you.
Right.
Yeah, that's the old way stockbroker kind of methodology of investing in the market. And, you just can't do that today. And that's just kind of what distinguishes your firm of how an individual ought to do it for themselves and how you should do it for a client.
And ultimately a client needs to know, and we show them, we want them to know, what is their rate of return after fees and after taxes? What are you actually keeping? And we build the portfolios, we try to build portfolios that maximize that for each specific client situation. And it can change for clients through time. You know, you retire and portfolio needs to be different.
Yeah, very few people know their rate of return after taxes, and fees.
That's right.
What is this slide about?
This is an easy way to think about whether you should be in the stock market. If you think about your time horizon, you ask me what the market will do tomorrow, I'll say I don't know, because to the left, basically a 50-50 proposition. This is a chart with the bars measuring the probability of loss. There's almost a 50% chance one day is down, and even a month there's a 40% chance that the stock market's down.
Well, that's what the chart means. The percentages on the right side of my screen indicates the percentage of loss potential in any one day, 1 week, 1 month, 3 months.
And this goes back to 1930 and looks at all of these periods on a rolling basis. So every single 5-year period since 1930, 80% of them were positive, 20% were negative. So one of the first simple questions I ask a client or potential client, how much of this money might you need in the next 5 years? And they say, 0 chance I need it. I have a lot of other money elsewhere. I'll say, good, you know, you're a good candidate for the stock market because you have statistically an 80% probability of that value increasing over 5 years and 90% over 10 years.
Okay.
You always hear your time horizon is key. Another thing to understand about investing is compounding. And it's the reason the stock market really works in your favor. Over this period, stocks on 1 year in green returned 7%. Over 5 years, they didn't return 7 times 5, being 35%. If you're reinvesting your dividends and compounding, you're making money on your money, and the 5-year total return was 42%, and the 20-year return was not, 20 times 7, it was 301%. So compounding is very powerful, and oftentimes we do dividend reinvestment and utilize cash that's built up to keep putting money into the market for a client, and it works really well over the long term.
It's the compounding concept is hard for a young person to understand, but it's, some people call it the 8th wonder of the world, but it also works in reverse. When you have debt, that
Right.
debt accumulates and compounds as well. And yet consumer debt is just at an all-time high, and it keeps compounding. And so do you deal with clients' debts when you first meet with them?
That is incorporated in some planning to try to make sure that a client situation is sustainable, that they're spending within their means, that over time they're building equity, paying down debts, ideally only having debt in their home, which is a productive liability. But certainly credit card debt, we're going to push clients to extinguish that, even at the expense of selling their investments.
I see it as well in reverse mortgages. A 70-year-old gets a reverse mortgage, and then 20 years later, in their 90s, they look at the amount of debt that they have created, and the compounding of that debt is just enormous.
That's right.
Anyway, next slide.
The next slide is important as well. We're not going to buy companies that are losing, generally not going to place money in companies that are burning cash, losing money, don't yet have revenue. That's speculating. If you want to buy a biotech stock because you think the drug will be approved, okay, that's not our game really, because I know the phase 1, 2, 3 success rates and they're low. So if you have large losses, a 50% decline, you have to understand the math. If you had $100, it's down 50%, you have $50. To get back to even, you need to make 100%, make $50 on the $50. The math is pernicious if you have large losses. And so that's the reason to have, dividend paying stocks and high quality businesses that you should be able to hold for a really long time without seeing large losses.
Sounds like a Warren Buffett type of style of investing.
Very, very much. Yeah, that's the idea. Know what you own, and buy stocks like you were only able to buy 10 your whole life, and make careful decisions. And then there was an article in the Wall Street Journal recently about Warren Buffett's orientation for dividends, and you see why here. If you have a total portfolio, the dark blue is just appreciation based on the S&P 500 index since 1980. But if you're reinvesting your dividends, you're 3 times higher almost than the light blue, just by owning dividend paying stocks and reinvestment on that. So we're fans of dividends. Own a lot of stocks that have dividend yields in the 2-4% range.
And dividends are taxed at the 15% capital gains rate, correct?
They're taxed at the cap, as long as it's a qualified dividend, that means tax capital gains rate. Most people are at the 15% rate if a couple's making less than $550,000. So
okay,
very tax friendly to collect dividends. This is another favorite chart. When people get political on me, I just show them this slide. And I don't care who you like or dislike, red or blue. The stock market's.
well, it shows right now that under Biden it's going down. So
Yeah.
all the Republicans out there ought to be happy.
It's kind of an accident of the calendar. Some of this, like the Bush administration, second one, caught the tail end of the 2008 financial crisis, where the stock market climbed 50%. So the Obama administration got the recovery. Some of it, but I'll tell you what does matter politically is not just party control of president, but across Congress. And the best environment has been some mix of party control, which we have now, and it's fairly the returns have been a little bit better because things are more stable, I'd say.
Yeah, the stock market hates the unknown.
Right. Yeah. And so after things like midterm elections, the stock market tends to firm up, and when there's more understanding of political dynamic. This is just a very interesting study that was done. You see from 2002 to 2021, 20-year period, how did different types of portfolios do? So the S&P 500 in green was returned 9.5% per year. You see some nice returns in real estate investment trusts to the left, high yield bonds, different portfolios, a 60-40 allocation. But the study was the orange. How did the actual investor actually do across owning these different things? And their return, believe it or not, was only 3.6%. Why? I think it's because I see this. There's this temptation to look at what worked best the last year, the last 3 years, and move your money toward it. But that's the past, and there's things cycle in and out of favor, in and out of success, and you have to form a strategy that makes sense for the next 5 to 10 years, absent any changes in your financial life, and stick with it, because there'll be periods it doesn't work, and you have to just think long term. Don't make a lot of changes all the time.
Change. We are the no change workshop. Because making changes is the tax consequences, fees,
Right.
Decision making. Change is our worst enemy. And the thing of it is when we look at this stuff on a daily basis, or we managing our own, we want to manipulate and we want to make changes, and it's psychological. Hey, if I make a change, it might get better. And usually you allow the market to catch up with you, not you try to catch up with the market.
Yeah, and you have to be a little bit contrarian actually to do better and invest in things that aren't as popular. The other thing I'm going to try to accomplish today is to make you the no mutual fund workshop. And this chart shows that the majority of mutual funds over 3, 5, and 10-year periods, the last 10 years, have underperformed, whether they're U.S. large company funds, small company funds, or foreign funds. I mean, these are the facts. These are the statistics that show how poorly active managers have done. And so buy and hold investing, passive investing, exchange traded funds, I think, are superior.
Yeah, we've seen a major change in this in the last 10, 15, 20 years. You don't, and by the way, the vast majority of mutual funds have active managers, and there are close to between 20 and 25,000 mutual funds. There are more mutual funds out there than there are stocks.
And if they're charging 1% and they own 200 stocks and they're turning the portfolio over every year, you're getting killed on taxes. They can't beat the market because they own the market, and then you're paying this big expense. So I just think
When you have the free meeting with the your clients, do you kind of go through what they own and kind of give them a little background on the mutual funds that they may own?
we have a nice analyzer tool through Morningstar where we can put in all the mutual funds and see collectively what that portfolio looks like. And people are oftentimes surprised that they own 3,000 stocks and they're paying 1.5% for that privilege.
Yeah.
And our advice is hire us or sell everything and buy the S&P 500.
Yeah. Okay.
Pete asked us to make this chart a while back just to show how powerful it is to defer taxes. So we call our equity strategy for taxable clients tax optimized equity investing, because we're trying to buy high quality companies we can own for many years to defer taxes. And under some assumptions here with 6% appreciation, a 30% tax rate, and 50% turnover, so if someone was selling every 2 years, that versus not selling, buying and holding, after 20 years, starting with $100,000, you'd have $160 extra $1,000 by just being a buy and hold investor. It really adds up over time. And so whenever we're thinking about selling something, even if we think, oh, maybe this investment isn't as good as when we invested 3 years ago, if it's appreciated 100%, if the tax implications is losing 30% of tax, the real question is this investment likely to go down at least 30%? And most of the time the answer is no. Okay, so a quick run through the current environment. I'm bullish on the stock market because inflation should be receding, and it has been and should continue to do so. These are monthly returns in the stock market since 1947 by inflation regime, and we've been in the yellow for the all last year and into this year, and above 5% inflation historically produced subpar monthly returns, 0.4% per month, so not even 5% per year. We're headed to the green here this year, and that puts returns, at least historically, per month at 0.9%, so almost a 10% return. So inflation really matters. It's a big driver of the stock market, and last year that's a big reason the market was down, and it's also a reason the market's up this year, and I think the trend is very favorable with respect to inflation. Last year's decline made the stock market cheaper and closer to a 25-year average, whether you look at price to earnings or CAPE is cyclically adjusted price to earnings, looking at the last 10 years earnings. Dividend yield, everything improved with the decline last year. And I'd say this chart shows that investing in the stock market on a price to earnings ratio is about normal at a 25-year average PE. This is a very interesting chart. If you know the price to earnings ratio, how does that correspond to the forward return? You're supposed to know what the valuation is and what you pay for the stock. Well, it doesn't mean a whole lot for 1 year, because on the left, there's not a strong pattern of what the price to earnings was and what the corresponding 1 year forward return was. And
Tell us what this chart should show us.
It should show us what you see on the right, which is as of March 31st, the price to earnings ratio was 17.8, and there's a trend line to the right downward, because as you go to the right at the bottom axis, you're moving to a higher price to earnings ratio. And then on the vertical axis to the left is what was the 5-year annual return from each of those PE levels. And so
PE stands for
price to earnings.
And how do you determine price to earnings? The price of the stock and then the earnings of that company for that year?
Yeah, for the next year.
And what is a high price to earnings ratio and what is a low price to earnings ratio?
The general rule of thumb is, if you're paying more than about 20 times earnings, you can see here that that's on the high side.
Okay,
And when stocks have traded below 13 times earnings, the bottom dotted line, that's a standard deviation below average. So we're looking to pay, 13, 14, 15, 16 times earnings when we can. And if you go to the next slide, when you do that, toward the left, well, sorry, the right visual, the 5-year annual returns, when you've paid 10 to 15 times earnings, you've consistently had a positive 5-year rate of return.
okay.
So it does matter what you pay, the price to earnings, on a 5-year basis. Things can be kind of random on a 1-year basis.
Okay, let's go to the next slide.
Or said another way, an expensive market can stay expensive and a cheap market can get even cheaper in the short term.
Yeah. We had a 25% drawdown last year in the S&P 500. This shows the other 10 times that happened since 1940 and what were the 1, 3, and 5-year returns like. Blue is after those 25% declines like we got last year. Returns are above average, and 10 out of 10 of the 5 years were positive. 9 out of 10.
So
1
what
year.
you're saying is when you have a downturn, the spike is quite high on the
Right.
upside.
There's big recovery potential following the kind of drawdowns we had last year, and your odds of making money are higher.
Okay,
We watch sentiment, consumer sentiment. This is a tricky chart, but the gray is just the changes in consumer sentiment over time. And at the bottom, those blue dots is what was the 1-year return in the stock market from those lowest sentiment points historically. And the 8 sentiment drop in a year from there, the S&P 500 delivered 24.9% on average. So you get above average returns when consumer sentiment is depressed in the next year. And we show this chart because last fall, sentiment was extremely low, consistent with those past bottoms. And I anticipate the next year or two should have above average returns, given we're coming off of that depressed sentiment.
wow, that's 62. It seems like, it seems like the lowest sentiment according to this chart for past 40 years, or is it that from 1975? Yeah.
Yeah, it was, well, it's interesting because the last time it got down to that level of 50 was in May of 1980. That's the last time we had a lot of inflation in a stagflationary environment, very similar.
Yeah.
Last point on the stock market. So we recommend you invest globally. Look at your portfolio, or we can look at it. Do you have some exposure outside the US? We recommend you should.
John, when you say some exposure, what percentage of a person's portfolio ought to be in the global?
If you look at the global equity market, foreign stocks represent about 45%, US is about 55%. We all have a bit of a home bias. There's more strong companies, I think, in the US, more technology. So we're allocating about 25% internationally.
Okay. That's just a kind of it's not a recommendation. It's just kind of a rule of thumb. You're averaging around 25%.
Yeah. We've wanted to have a bit more than sometimes in the past because of this chart. When the purple was going on, outside the US, stocks did better. When the gray's been going on, the US did the best. And the last decade has been completely dominant by US stocks. And it cycles, right? It goes from purple to gray to purple to gray. This was just a really big, long cycle. And if you look carefully to the right, we're starting into purple. So we think that there may be some leadership outside the US because things have been pretty rough in China, in Europe, and things like that. And there's recovery potential. And from so you gotta look at the valuation, right? This is the valuation of international stocks. The price to earnings discount versus the US has been at a 2 standard deviation level of a third cheaper. So the PE outside the US in the box is 12.6 instead of the S&P 500 at 17.8. And on the right, the dividend yield is significantly greater buying outside the US. You actually make 3 to 4% investing in international markets just on the dividend yield. And then international value. So we'll look in portfolios. Should we have a value orientation, a growth orientation? International value is especially compelling. The cheapest relative to growth over this time frame here since 2006, and it's gotten pretty extreme.
Yeah. By the way, there are some mutual funds that classify themselves as a growth mutual fund, and there's others who classify themselves as a value. Are those terms still as important as they were in the past, or are you a value manager, or are you a growth manager?
We're a value manager from the standpoint that we're opportunistic and we're contrarian. But sometimes that means we're owning things that have growth elements. They've become very controversial, and investors are shying away from a growing business. So I don't
give us a value stock and a growth stock today. So just to give people an awareness of what you're talking about.
Well, the quintessential value stock right now would be any bank. There's
Any bank.
tremendous fear that banks are going to be even more regulated, pay even more for their FDIC insurance, and maybe some of them have to get bailed out or sell out or have capital infused. And so you can buy regional banks for 3 or 4 times earnings. You can buy money center banks for 6 or 8 or 10 times earnings.
So news is bad, usually
Yeah.
when you buy a value stock.
And a growth stock would be like an Amazon,
Okay.
It's
Tesla.
where it's all about the future.
Yeah.
How much can e-commerce represent? Because it's still a pretty small part of consumption. How many Teslas can Tesla sell over the next decade? Those are growth stocks.
Have you met anybody who can foretell the future accurately?
I mean, I can foretell the future on if a company can recover and get back to the valuation it's traded at normally.
Uh-huh.
And that's what we do. But I have no idea how many Teslas get sold.
Yeah.
It's hard to call that one.
Okay, next slide.
All right, Kurt.
Kurt, you're
Yeah.
up. You're up to the plate.
All right, about 15 minutes here. So we're moving from the exciting world of stock investing to the boring world of fixed income. I'll try and keep everyone awake here. So
Why is the fixed income so boring? And in comparison to the equity market, what is the size and the complexity?
well, I would say a couple things. Fixed income, certainly over the last decade, has been much more boring than the stock market because the returns have been a lot lower. And you don't have the outsized returns you can get in the stock market, particularly if you pick some winners. With a bond, you're looking to just get your money back with interest. And then despite the lower returns, it actually is a bit more, I'd say there's a bit, I don't want to say it's more complex. I don't want to,
I would say so. I would think it's a lot more. You're in it, you understand it, but I find it much more complex.
Yeah, well, there's just different analysis that you go through to understand the risks of a bond than a stock, right? I think we all kind of intuitively know a company's either growing or it's shrinking.
Mhm.
When it comes to the analysis of solvency and ability to service one's debt, it's a different analysis.
Yeah. So what is a fixed income?
So fixed income it's more or less synonymous with bonds. So just like equities or stocks, fixed income would be referring to bonds. And that is a loan to, could be a loan to a municipality, the US government, it could be Disney or Starbucks in the case of a corporate bond, but it's a loan to some sort of institution that's agreed to pay you back in the future and pay you interest along the way. And so that, when you own a bond, you're actually lending money. So you are a creditor or you're a lender. And the bond you are purchasing, the issuer of that bond, they are the borrower. So you are loaning money. So with a stock, you're an owner in a business. With a bond, you are a lender to that business. So the role of bonds or fixed income in a portfolio, first and foremost, it's a steady source of income. Most bonds tend to pay interest semi-annually. So every 6 months, you're receiving coupon income. Provides a level of portfolio diversification. typically, diversifying against, stock market risk. Many sectors of the bond market will move in the opposite direction of the stock market, particularly when the stock market goes down and there's volatility. Bonds will appreciate higher quality portions of the bond market. There are portions of the bond market that are more highly correlated with the stock market and will not provide that level of that hedge. So it's important to know what you own. But on the whole, they reduce your overall portfolio volatility. One, because they're just a less volatile asset class in their nature. And two, because now you're investing in two different asset classes, stocks and bonds, that are moving in different directions.
Well, we haven't had a lot. Your number one is a steady source of income. So what's happened, in the income area, in the bond area, just in the last year?
Yeah, well, I'll show you some examples, in a couple slides, but generally, broadly speaking, interest rates have risen significantly in response to the inflationary environment that we've been experiencing, and the Federal Reserve raising interest rates. And so that does two things. One, the existing bonds that people held lost a lot of value last year, as we'll see. But two, on a go-forward basis, there's now a lot more yield to be had. And we'll walk through some of those examples as well. Thirdly, bonds are, this is not always is intuitive, but bonds are also a hedge against deflation. So if interest rates, when you have deflation, typically that means that interest rates decline. And if interest rates are declining, the bonds you hold will increase in value because they're paying a particular yield. So as rates decline, that yield becomes more attractive relative to the new interest rate environment. It's kind of the opposite of what happened last year. And then lastly, they're a source of liquidity. John spoke earlier about how much cash flow are you going to need from your portfolio over the next 5 years? A very basic way to go about your asset allocation is whatever you're going to need over the next 3 to 5 years in cash flow, put that in bonds, and the rest can go into stocks.
Yeah, people don't realize that because, hey, you need a new roof. The last thing you want to do is sell that stock that might be down. That's that bond that you can use to pay for that roof.
Exactly. Key components of a bond, this is the terminology piece. The issuer, that's who's issuing the bond. Is it Coca-Cola? Is it Starbucks? Is it the US government? Is it the state of California? In the case of municipal bonds, so understanding that. What is and those issuers have credit ratings, right? Moody's, S&P, and Fitch, those are the ratings agencies. They rate those bonds, starting at AAA for the highest quality, then AA, single A, triple B, and then when you get below triple B, now you're talking about high yield or junk bonds. Those are lower quality bonds.
And lower quality bonds pay more?
Yes, assuming the same structure and the same maturity date, yes, they'll pay a higher yield. Just like, if you go take out a mortgage, if you have a lower credit score, you'll have to pay a higher rate of interest rate. The coupon, that is not the income rate, that's not your yield, but that is the income stream. So the coupon will pay typically semi-annually, and it'll pay a certain percentage of the face value of the bond. But the other thing that's important to understand is the price that you pay for that income stream. And if you scan your eyes down to the bottom here, yield to maturity is really the most important thing when you're looking at an individual bond or a bond fund, because that incorporates both the coupon income, the interest income that you receive semi-annually, as well as the price that you're paying for that income stream.
So somebody should be highlighting yield to maturity, put a big circle on that. You need to know if you own bonds, what is your yield to maturity?
That's right. We were in a long period of where interest rates had declined. So in the 2010s, people look at a bond that was paying, 6% coupon income, and they think they're earning 6%. What they don't realize is they didn't pay 100 for that bond. They paid 130, so they're actually, that bond's going to mature at 100. So they're going to lose, over a 10-year period, 30% on the price of the bond. That's going to lower your total yield.
Kurt, would you recommend individuals buy individual bonds like they do stocks?
No, that if you're a do-it-yourselfer, bonds are complex, and the the work that is required will not be worth probably the extra return. So you're probably best off going in a diversified fund. And this is a case where, in the bond world, the majority of actively managed mutual funds have outperformed their benchmark. And that's really because the benchmark is, it does a couple things. One, and this is why you don't want to invest passively in the bond market, is unlike the stock market where, if you buy the S&P 500 index, it's a market cap weighted index. So Apple has the biggest weighting in the S&P 500. It's the largest company, right? And there's probably something to that. It's a large company. It has developed, a strong competitive advantage, and that profitability should maybe continue. In the bond world, if you go buy an index fund, what's the biggest component of a bond index? It's the biggest debtor. It's the person who has the most debt outstanding. So do you really want to be overweighting the person who has the most debt outstanding? Probably not. So that's one of the reasons. The other reason is that the bond index wasn't developed until later on, and it was really created by bond managers and created in a way that it's a low bar for them to clear.
Yeah. Do not buy bonds individually, and do not buy bonds from brokers. Okay. So this is where a fee-only fiduciary advisor pays off in gold. And we'll talk a little bit more about it. Let's go to the next slide.
Yeah. So just like a stock, two components of total return with bonds: the income that you receive. For a stock, that'd be the dividend income. For a bond, that's that semi-annual interest that you receive. And then the price return. So the price does move. Price does go up and down in bonds, much less so than with the stock market. If you buy a stock, a lot of your return over shorter periods of time will be the price movement and less the dividend yield. It's the reverse with the bond market. And if you hold a bond to maturity, bond portfolio to maturity, 90% of that return is going to come from the income. And that's because any sort of price gain or decline is ephemeral. If you buy a bond when it's issued at 100, it will mature at 100 so long as it doesn't default. And any price movement in the interim will amortize away as the bond amortizes to par. So it goes back to 100. So you're really receiving that income stream. Now, if you buy a bond at a premium above 100 or a discount below 100, there will be some permanent price gain.
So all bonds are priced based on 100?
Correct.
Okay. And so if it's below 100, you're buying an undervalued bond when it pays off. If you're buying it above 100, you're paying a premium over when it matures.
That's correct.
Okay. Next slide, please.
Yeah. So two ways to increase yield, right? First is to extend maturity. That's the date at which you get your money back, right? Your original investment. So instead of buying a 5-year bond, you buy a 20-year bond, right? The longer you're going to lend someone money for, the higher the interest rate that you will charge. That's intuitive. But that increases your interest rate risk, right? And we've seen that. This is the issue that's been taking place in the banking system right now, is you have a lot of banks who took in money from depositors, and then they went out and made loans or purchased bonds, which is effectively making a loan to the bond issuer, with long maturities and at very low yields in a different interest rate environment a couple of years ago. Well, interest rates have risen, and the value of those bonds that they purchased has declined meaningfully. So the value, when interest rates rise, a bond that doesn't mature for 20 or 30 years is going to lose a lot more value. The price will decline much more significantly than a bond that matures in a year. Why is that? Think about it. If rates increase and you can now invest and earn a higher yield, but your bond matures in a year from now, you're only missing out for a year. Once that matures in a year, you can take your proceeds and go reinvest at a higher rate. If you're in a 30-year bond and you have to wait 30 years to get your money back before you can go reinvest it in today's interest rate environment, well, interest rate environment's likely to change in 30 years, right? So that's why greater interest rate risk with longer maturity bonds. And then the risk that I think most people think about is credit risk. Clearly, if you're lending to a riskier borrower with a riskier balance sheet, then you're going to charge a premium for that. So you can dip down in credit quality, but you got to understand that credit risk, or really that default risk, the risk that they won't pay you back, increases. And that's more like what went on in the banking system in 2008, where banks held a bunch of mortgage-backed securities, where suddenly investors started to realize, well, I don't know that they're going to be paid back on these, because I don't think that people can continue to pay these mortgages. And so that was a credit issue. What the banking systems are experiencing today, that's an interest rate issue. Okay, so bonds, now a worthwhile component of your portfolio. So the interest rate environment has changed, right? So we saw this chart for the stock market. It's a little more ho-hum up until last year for the bond market, right? Peak to trough decline are these red dots within any given year. But the gray bars are your return in the bond, or the return that the bond market is delivered each year. Prior to last year, so you see what an outlier last year was, down 13% in the bond market, at one point down 17%. If you go back to the year prior to 22 that everyone talked about was 1994. You can see, you scan your eyes over to 1994, you see the bond market was down 3%. At one point was down 7%. That was enough to put Orange County into bankruptcy in 1994. So given what took place last year in the bond market, perhaps not a surprise that we're seeing issues in the banking system, and there's a lot of concern right now about flow-through effects to asset classes like commercial real estate that have relied on that bank lending traditionally, and where mortgages are going to reset. So we won't maybe get in the weeds there unless someone has a question on it, but it's reasonable to think that there's going to be some market
dramatic. That's dramatic. That from a year ago. I mean,
we basically had an unwinding of a decade of declining interest rates in a trend. So
it's almost like a shock to the system.
Yeah, and it's so funny because people say, oh, well, 60-40 portfolio is dead now. I don't want to invest in bonds now. It's like, actually, it's the opposite. You shouldn't have been investing in bonds, and now you should be.
Yeah.
Returns are much higher, and this is why you should be. So if you take a look at these gray bars, these represent the range that over the last 10 years, the range in yield for these different portions of the bond market. You scan your eyes to the bottom, you see treasuries, municipal bonds, investment grade or high quality corporate bonds, not junk, mortgage-backed, asset-backs, and European bonds. If you look at these gray bars, this is the range of where the yield has been over the last decade. And the purple horizontal bars, that's the median, that's the average, right? That's where the average yield's been. These blue diamonds show you where the yields are today. So everything the yields are up across the board. And this is another way of, you can see that here as well. This is at the end of the first quarter, the far left column. Top half, you see the treasury market, different maturities, 2 years, 5 years, 10 and 30. You can see here we have an inverted yield curve where a 2-year treasury pays more.
Okay, hang on a second. Use the term inverted yield curve. What the heck are you talking about?
Yeah, so in a normal environment, longer dated bonds, 10-year, 30-year maturities have higher yields than shorter maturities, 1 year, 2 year, 5 year.
Okay.
It's an upward slope. So the longer you lend your money to the US government, for instance, or to a corporation, the higher the interest rate that they pay you. So right now, the yield curve is, they call it inverted because it's essentially upside down, where counterintuitively shorter dated bonds pay more than longer dated bonds. So you receive a higher interest rate lending someone money for 2 years than you do lending them for 30 years. And so why is that? Go ahead.
No. Why is that?
Why is that? That's because the market believes that interest rates will be lower in the future.
Okay.
Right. And so investors are saying, I'm comfortable locking in a 3.5% treasury yield for 10 years right now, because I believe those yields are going back down in the future. And if I go buy a 2-year bond yielding 4%, 2 years from now, I have to reinvest that money. And I think yields are going to be much lower in 2 years. So I'd rather have 3.5% for 10 years than 4% for 2 years. And then when 2 years are up, suddenly I have to go find a place to put my money. And I think treasury yields will be in the 2s then.
So these charts are telling you what people are thinking. The professional market, what they're thinking as to what's going to happen in the future.
Right.
And so what individuals who are investing should know, whether doing mutual funds or individuals, they need to know what their portfolio is like. Or do they have 2 years? Do they have 5 years? Do they have 10-year bonds in their portfolio? Because it makes a huge difference as to their return.
Right, that's right.
And what are tips? You have tips on here. What does that mean?
Those are in the TIPS. The acronym stands for Treasury Inflation Protected Securities. Basically, they're inflation protected bonds where the prices of the bonds is linked to inflation. It's not. I think people get excited about them when they think about that, but it's not how the returns that those generate and the performance of those bonds is not about the level of inflation, because that's priced in to the TIPS market. It's about what is actual inflation turn out to be relative to what expectations were. So if expectations are that inflation will be high and it turns out to be high, that won't do well in TIPS. You do well in TIPS if inflation expectations are low and it turns out to be high.
What is, I'm just going to go down just for the most important ones. Municipals. What are municipals?
Municipals are issued by municipalities. So that could be a state government like state of California. It could be a county, a city. It could be a water or sewer district. It could be a school district. It could be Hoag Hospital. They are, it's really municipals. It's a tax exempt market, right? Where they are able to issue debt at lower yields because it's tax free. So for
tax free on both statewide and federal, or just state?
So if you buy a municipal bond issued by a California municipality, it will, as a California resident, it will be both federal and state tax exempt.
How about U.S. Treasuries? How are they tax advantaged?
You are exempted from California state tax on a U.S. Treasury bond, but you still pay federal.
Okay, let's go to the next slide.
Okay. So, just another illustration of the change in the bond market here. For a long period of time, the earnings yield, which is the reverse of the PE ratio in the stock market, the earnings yield has been meaningfully higher than the bond market. And this wasn't the case prior to 2008, right? These were more in line. And now we're back to that type of environment. You can see here in 2022 at the end, the bond yields have jumped up and now mirror what you're getting in the stock market.
Sorry, Kurt, I missed it. What does IG stand for?
Investment grade. So this
investment grade.
Blue line is high quality. I should have mentioned that. Yeah, the blue line is the high grade or high quality corporate bond market, and the gold line is the stock market.
Okay.
And then, when people ask us, what do you think this bond portfolio is going to do over the next 5-10 years? John talked about PE ratios in the stock market and what that portends. If you think about the bond market, look at these correlations. These on the upper right-hand corner, you see these R squareds, and you see these dots. I mean, this is a very, very tight trend line. The correlation between your starting yield in your bond portfolio and your return over the next 5, 7, 10 years is really, really tight. So whatever your starting yield is when you're buying, when you buy a bond or a bond fund, that is very likely to be your annualized return over the next 5, 7, 10 years. And so we'll talk a bit about, how you can optimize your bond portfolio now. First thing I would start with is cash is
It's king.
basically an investment. It was not for a long period of time. You earned nothing, but money market funds prior to yesterday's Fed rate hike, the ones we own, yielding 4.7 for tax deferred accounts. We own tax-free money market funds for taxable accounts for high income.
My bank account is not even giving me a 1% return.
That's right. That's right.
Well, you think that it's going to change?
No, they can't afford to, because banks have invested in long-term securities that are paying low yields. So they can't then turn around and pay you more than they're earning.
So people may want to consider opening up a brokerage account with a Schwab or a Fidelity or with E-Trade or Ameritrade, just to get the money market rate.
And these yields change daily, but they, so they're going to be increasing now with the recent yesterday's Fed rate hike. And so what we do is on a monthly basis, we take a look at all of the money market funds that are available and all of the cash that we have here at the firm, whether they're in courtesy, accounts for clients, or they're simply the cash portion of a portfolio that they may have that's uninvested at the time. We move that to whatever the highest yielding money market fund is that we are comfortable with from a credit quality perspective. These are predominantly US Treasury bills that these funds hold. So this is something else to mention here, this fourth bullet point. People have been concerned about, their bank accounts, their checking accounts, particularly if they have over 250,000 in the bank, which I wouldn't recommend. But what happens when you put money in the bank is they lend it out, right? So no bank can withstand all their depositors, and no matter how high quality, Bank of America, JP Morgan, Chase, they cannot withstand all their depositors asking for their money at the same time, because they turn around, they lend it out. In a brokerage account, when you hold a money market fund, that's just like a stock or a bond. It's a security that you hold inside of your account. So even if the brokerage account, even if Fidelity or Schwab goes bankrupt, that security is still held in your account. And so the SIPC insurance, that doesn't kick in until suddenly you're talking about a brokerage account where they can't find your stock or your bond in your account, which that doesn't happen. Those are held, as long as you don't have a margin account, those securities are held in your account. And even if the brokerage account goes under, you will still have that. So it is safer than a bank to hold a money market fund.
So you put down, I'm going to ask you what the last bullet point means.
Yeah, we manage courtesy cash accounts for clients, where we'll just open up a brokerage account at Fidelity or Schwab, link it to their bank account so that they can have costless flow of funds electronically between their bank and the brokerage account, and then it goes into a money market fund.
You don't charge for that?
No, we don't charge a fee for it, and we move the funds around to each month to whatever the best money market fund is to be in at that time. And sometimes for a taxable account, if we're not talking about an IRA, if we're talking about a trust or an individual account, that can really change depending upon municipal bond yields. I mean, last month the muni bond fund we owned, muni money market fund we owned, was yielding 3.8% tax-free, California tax-free too. So that was compelling. So all our taxable accounts, regardless of the client's tax bracket, held that municipal money market fund.
And this changes all the time. If somebody, you need, and you don't get this from the news. It's you got to do your homework. It's a lot of work.
It is. I mean, to give you an idea, the money market fund we were in last month, at the beginning of the month when we bought it, the yield was 4.7%. By the time we swapped out of it, it was down to 4.1. In 30 days, it declined 60 basis.
Yeah. Kurt, I think you should go to the next slide. We have a few more minutes, and the next slide's a good one.
Yeah.
We got 5 minutes left.
Okay, then I'll rip through here as best I can. So, here's what we focus on. Minimizing costs first and foremost. So we do that by owning individual securities, where we can. We buy individual municipal bonds. We buy individual corporate bonds. We've been doing that since the 90s, very comfortable doing so. We buy individual preferred stocks as well, which pay nice tax advantage yields. Managing to your tax bracket. So again, if you're above, if your taxable income in California is above, 360,000, you probably are better off in municipal bonds. So always thinking about the tax status of your account and the bracket that you are in. Balancing income with liquidity. So you want to ladder your bond maturities, or if you're buying a fund, you want a fund that ladders maturities. And what that means is you're buying a bond that matures in 1 year, another one that matures in 2, 3, 4, 5, and so forth, such that you always have shorter term bonds that are maturing. So A, you have liquidity, and B, if interest rates rise, you can reinvest those proceeds at higher rates. You want to utilize your full opportunity set. So, another thing it's not a fit for everyone, but for certain clients, there are private credit opportunities and ways they can generate income through real estate. In the public markets, you can do that through REITs. We tend not to like those as much because they tend to be expensive, but versus the private market. So there are opportunities to do that. And then lastly, when you think about the maturities of your bonds, you want to try and match those and line those up with your liquidity needs. We talked about how much money you're going to need over the next 5 years. Well, if you need, $200,000 in income over the next 5 years, you don't want to plow all of that into 30-year bonds, right? Because if interest rates rise, those are going to get hit hard. So something to think about.
Go to the next slide.
Of course, we mentioned this, manage your tax bracket. You can see in California, most people are at 9.3. If you're anywhere from 130 to 670,000 in income, you're at 9.3. And then you see the big jump in the lower left-hand corner for the federal brackets. Big jump from 24 to 32. So anyone who's in that 32 and above, that's when you want to start considering municipal bonds. And then, in the upper right-hand corner, capital gains. We talked about this before. A lot of people are in that 15% bracket. I think people think about it as 20%, but oftentimes tends to be 15. We can skip through this municipal slide and just think about, are you capturing the yield that's available today? This is what we're getting today in the market. We're getting 7% tax equivalent in munis, 5% in high grade corporate bonds, mortgage backed, we're getting 6%, preferred stocks above 6%, and those are tax advantaged. Our managed income strategy invests in the high yield bond market, and that's doing 8%. And there's things like interval funds with quarterly liquidity where you can get 9 to 10, and in private credit, you can get in that 9 and 10% range as well. And then this is a snapshot of our portfolio. I don't think we need to get into all the details here. I know we're short on time, so I'll wrap up just by mentioning who we are. So we talked about this before. We're Knightsbridge Wealth Management, been around since the 90s, employee owned, fiduciaries. See the things that we think about when we're investing client accounts. Mainly controlling taxes and fees. And then, these are what our typical clients are. It's people who want to know there's a plan in place. They're maybe questioning the sophistication of their current portfolio. They want access to the people who are building their portfolio, and they want something beyond just a basket of mutual funds. And they also want to know that their tax bracket's being taken into account. And, they want, of course, their plan to be designed to them specifically. So with that, if anyone's interested in just having a second opinion on their current portfolio, feel welcome to contact us. There's no obligation on your end, and we're happy to give you our thoughts.
Yay. You did it, Kurt.
Just print, but I made it.
Yeah.
Want to stop sharing your screen,
Yeah.
Yes.
please? Thank you.
What we've been doing is in our previous sessions, allowing some questions to answer.
However, before we do that, Pete, what we're going to do is we're going to say, thank you very much for being here, because in a moment, we're going to turn off the camera. And so thank you very much for being here. It's your money. This has been week 3. And next week, we will talk about the investment world, I believe, as the schedule has shifted around. So I thank you very much. And at this point, yes, I'm going to turn off the camera.